Welcome to the Stock Play of the Day. Today's symbol is IBB. It is the iShares NASDAQ Biotechnology ETF. Hello, everyone. My name is Brian Overby. I am the Senior Options Analyst at Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist at Ally Invest.
All right, Lindsey, let's go and jump right into it. What are we seeing in the markets this week?
Sure. Well, today, starting a brand new week, we're seeing green across the board. That is for the S&P 500, the Dow Jones, the Russell 2000, just slightly, though, in positive territory after a big sell-off in the market on Friday, which guess what drove that? Once again, it was coronavirus fears. So we've seen this market be pretty indecisive with regard to what the coronavirus means overall on a longer term basis for the markets. We've seen some swift up and down action really on Fridays, some hard selling the last two Fridays especially. But still, this morning, when I look at the S&P 500, we're very close to last week's new all-time high, which we got to in a very sharp snap back from the big pull-off that we saw the week before on the back of coronavirus fears. So, today when I look at market action, there's not a lot of news driving the market. On the economic calendar, we don't have a lot of information. We'll wait till later in the week to get some information on retail sales, consumer sentiment, some more jobs data, small business confidence we get tomorrow. So those will be some things that we closely want to watch. We're also finishing up, bringing in the tail end of earnings. It's been a pretty good earnings season with the majority of the S&P 500 already reporting. We've seen numbers about 69% of S&P 500 companies have beat their earnings per share estimates, which is about in line with the historical average. So nothing too crazy on the upside or downside there. The sales numbers, though, have been coming in much better than expected. Usually you see a beat rate of about 50-55%, and we're above 60% for this quarter. So that's one thing on the bright side. But Brian, I do notice the VIX, it's coming off a little bit today, but it's still around that 15% area. What do you make of that?
Well, yeah, when we look at the VIX index, on the high end, we actually didn't see the fear factor escalate so high going into the big downturn because of the coronavirus. I mean, I really expected to see a little bit the VIX drift towards the 25, 26, 27 level. Never really got to that level. It came back down to the 18% level, and now it's dropped back down to about the 15% level. So even though we've had a big up move, we're not seeing the big down move in the VIX index, which usually goes hand in hand. And then also on the big drop in the SPX, we didn't see a big up move, showing that we had some capitulation up on the high end in the VIX index. So if I actually look at that SPX chart that we have up, we talked a little bit about a trend line that was forming, and we talked about the 3250 level, and we see that the stock was just kind of hanging out there for a little bit. And we talked maybe it could be setting a new trend, kind of forming its own channel. But basically, the market said to itself, coronavirus? What coronavirus? I don't really care about it. And it came climbing all the way back. As a matter of fact, in technical terms, you could say it had over 100% retracement of the big down move from the coronavirus scare. So what does that say about the markets in general? Well, we're once again getting mixed messages, which is commonplace after a big news event like the coronavirus and what's going on overall. But if we take a peek at the NASDAQ index, we kind of see that not only did we get 100% retracement from the big down move from last week, we've actually blown through it to the upside. So in the technology area, I guess earnings was a pretty big driver overall. A lot of the big FANG stocks in general, Apple, Google, Amazon, all announced earnings last week. And it was kind of odd because we really had, like with Apple, we had some big upside in it, but then it all retraced and all came back down. And now Apple is kind of trading in the kind of this nowhere land, just kind of looking where we're going to go. But overall, if we look at the NASDAQ market, we see this breakthrough to the upside. But then if we go and look at the small cap index, well, we didn't get that 100% retracement back. And in the small cap, you can almost be looking a little bit more bearish overall as opposed to the SPX, the overall large market index, and the NASDAQ index. And we can almost see in general head and shoulders, kind of a weird one kind of forming here, which would be more of an indication that it could break to the downside overall. So the markets are sending mixed messages. And I think we're going to stay in this trading range. And that's part of the reason why the VIX index has not dropped back to its lows, even though we're having a big bullish move at this point in time. So I guess the moral to the story is there's still a lot of nervousness out there, but the fact that we had 100% retracement back to where the market was at before the big drop down is in general a good sign for the market.
Yeah, Brian, you can definitely see some nervousness too when you look at the 10-year yield on the Treasury note. While the markets have been able to retrace back to new highs, at least the S&P 500 and the NASDAQ looking at even better numbers, you've seen the 10-year show some signs of caution. While it's up off of its bottoms that we've seen at just under 1.6, I think this morning it's at 1.55. It's under a little bit of pressure this morning. It's still off from its it was over at 1.8% earlier this year. So we still have a ways to go for the 10-year to get back to those levels that we saw earlier in the year. So that kind of signals some concern by investors as well. So you've got what seems to be investors really going to their trusty growth sectors, the technology sector. You're seeing that in the NASDAQ. But before we get into our big stock of the day or our big focus area of the day, I just wanted to remind our viewers that be sure to write down any questions you have for Brian or I in the right-hand side of your screen on the box there. We will be taking your questions at the end of the show, so we look forward to talking to you then. That's one of our highlights of the show.
Get into IBB, the NASDAQ Biotech ETF.
Yeah, so we decided to take a look at the IBB because, well, all this talk about coronavirus it kind of makes the case in and of itself for the need for biotech companies to really be exploring these types of viruses that can spread very quickly. We've had a handful of them over the last couple years. If you think of SARS, you've heard a lot about that in the news because it's the most recent one. The bird flu. There's a lot of different viruses that have broken out over the years, and biotechnology companies, what they do is really help to solve for those issues, but also some of the more prevalent issues that are you see in older folks, and some of these diseases like cancer that we've really been trying to conquer for quite some time. The biotech sector, it can be one that is very volatile over time, but I think in a period of greater market volatility, you can see this sector really be one area where investors feel more comfortable getting defensive in those periods of volatility, because especially right now, as you think about biotech, the industry has evolved so significantly over the past 5 or 10 years. A lot of that has to do with the advent of innovation within the industry. The research and development that's been done really has gotten to this level where it's happening much faster and furious than it ever has before. You've got a lot of investors interested in the space. M&A in biotech has been very high over the last couple of years. Actually, Allergan reported earnings this morning. They reported a beat, and they're acquiring AbbVie, which is one of the biggest biotech companies within the S&P 500. So that's a big deal that's expected to close at the end of Q1 this year. The biotech sector in general represents 14% of the healthcare sector overall. So it's a big component. It's a big driver of healthcare in general. But when, again, getting back to the fundamentals of the biotech space, it really comes down to not only is there M&A interest and opportunity here that could drive these stocks higher, the fundamentals have been improving. Not only have you seen sales improve as approvals for drugs have increased and the time for those approvals to happen have decreased under the Trump administration, but you've also seen these companies who spend a lot of money to do their R&D, you've seen their cash flow actually improve over the last several years, again, making them more attractive from an M&A perspective, but also from an investor's perspective, if you want to invest in these individual companies or the sector, the industry overall through the IBB, which we're taking a look at today. The IBB is up 1% on a year-to-date basis. It's up 13% over the last 12 months. That compares to, if you look at the S&P 500, the S&P 500 is up 23% over the last year. The healthcare sector is up almost 16% in the last year. So these guys have been a laggard. Also, so that is the number one thing that gets you intrigued. And then after that, you take a look at some of the valuation. Biotech trading at 13.5 times on a forward PE basis. That's about in line with its 5-year average, but it's a 16% discount to its 15-year average PE of 16 times. So the valuation here does look pretty attractive, especially when you're looking at a market where most sectors and most industries are trading at a premium to their historical valuations, which is, really is what happens when you see a market at reaching new all-time highs, like the current bull market that we are in. So we find this area an area that could be interesting, especially as volatility re-enters the market on the back of the coronavirus. We're going to start to see some economic data first out of China and then the rest of the world. So shows some slowdown. And the market right now is saying we're willing to look past that because we know that these types of viruses are only temporary in effect. But when investors, really get to see those numbers come in slower over the next month or two or three, you have to wonder that could create a little more volatility, especially when we thought that the global economy is starting to get on more solid footing after the trade deal with China and the U.S. passed phase 1. They're working on phase 2. We got the USMCA passed here in North America. So things started to feel better. We started to see some of that manufacturing global economic data turn around. We got positive data out of the U.S. last week, which helped drive us up to that new high for sure before coronavirus took us back down on Friday. So we're just looking at this sector as kind of a short-term way to get a little more defensive in a volatile market, right, Brian? What are you seeing from the options side?
Retracement all the way back to before the big downturn, all the way back to that range. And now the stock is kind of settled in, kind of deciding exactly, or I should say the ETF, kind of deciding where its next move is going to go. So with that said, the top 5 holdings in the IBB, all those stocks have announced earnings. So we're not looking at any more earnings forecast going out until the beginning of May, approximately. So that takes some of the volatility out of the index. 2 of the biggest components of the IBB are Amgen and Gilead Sciences. Both of those stocks have announced earnings. They make up about 15% of the ETF. But we see volatility, as you were mentioning, we see volatility in the stock price, not necessarily in the options world. We have a little bit of volatility as far as implied volatility is concerned. It's kind of at the middle of the range. And we have right now it's $122 stock almost exactly. So we get a little bit of premium because of that. So we're in the middle of the range. I would kind of expect volatility to be a little bit higher overall, just considering the overall outlook of the marketplace. And the VIX index and the S&P 500 index, which is the volatility of that index, that's trading around a 15% level. So I would kind of expect the implied volatilities to be a little bit higher in the biotech world. But if I look at the option chains, I see I'm going to stick the option paper trade for this week. I'm going to stick in the call options, and I'm going to stick in the 18-day option contract. because of the strategy that we're going to look at. And if I just highlight implied volatility here, on our option chain, we see this is the stock price right now, IBB. This is an active chain. It's at 122.02. We're going to go out 18 days to expiration, which is the February 28th expiration. We see the implied volatility around 20%. Now, on the low end, the 52-week range for implied volatility in IBB is down around 17%. On the high end, it's going to be up closer to 30. Now, remember, this is an ETF, and part of the reason why volatility is a little bit muted here is because it's based off of a bunch of stocks as opposed to one individual stock. So my strategy today, and I always like to give you my thought process. When I first thought about an ETF in general, I just think about buying options because usually volatility is muted, as I mentioned, and why not just buy options and make it simple? In a lot of instances, you just want to keep it simple in general. But when I started to look at the option premiums, I'm like, well, there's still a little bit too much risk for the type of delta that I would get on that option contract. So for example, if I'm going to go out 18 days in time, this means that we're looking at basically a short-term forecast. We think we might continue to get an upward movement in the marketplace overall. And then also, because of that 100% retracement from the stock low to the high over the last couple of weeks, maybe we can continue that move to the upside in IBB. So because of that, I thought about just buying a little bit in the money option contract and getting a little bit higher delta. But if I go down to the 120 strike 18 days away, I'm paying $360 for that option contract. And there's still quite a bit of time premium in that. If I look at the put side of the chain, this is the call side, this is the put side. If I look at the put side of the chain, it gives me a hint as to the approximate time value that I would be buying in that option contract. So the 120 strike is trading on the put side. We'll call the midpoint 140. That means I'm still paying quite a bit out of that 360 is time value. So I didn't like that. I didn't like that at all. I got a delta of 65. That's all right. I would like that to be a little bit higher. Then the time value would come in. But then we're getting fairly expensive in the option contract. So I made the executive decision that I was going to do what's called a long call spread. And I'm going to focus on time value, just like we did last week when we talked a little bit about Uber going into earnings. We focused on time premium and how much time premium we were buying versus how much time premium we were selling. And here is the long call spread inside the Ally Invest Options playbook. And we see this is a bull call spread. That means we're bullish. That's another name for it. Some people will refer to it as a vertical spread. But we're going to be, the stock is somewhere in between these two strikes, strike A and strike B. That's where the stock is currently in our situation on IBB. We're going to be buying the in-the-money option, selling the just out-of-the-money option, and paying attention to how much time premium we're buying versus how much time premium that we're selling. So let's get into the actual strategy. If I scroll down, I look at our options workbench and our profit and loss calculator. I got my screen zoomed way in, so I can't quite get all of it there. We're doing a 4-point wide spread. And honestly, the market has moved up since I first put the spread in here. This thing was trading for $2.10. Now it's trading for $2.25 at the midpoint. A midpoint would be a great execution, but as always in the stock play of the day, whenever we talk about option strategies, they're not meant to be recommendations. We're just trying to learn here. So I like to try to work you through the process, the initial process of thinking, well, gee, maybe I should just buy a long call. And then in this instance, now I'm thinking, well, they're a little bit too expensive. I don't want to buy a long call. I think I'm going to do a long call spread and see how much premium I can get. So in this instance, we were looking at $1.40 in time premium approximately on the call option that we were buying. So I wanted to sell something that was close to that. But I still want to give myself some upside. So I looked at the 124 strike call and I brought in $1.15 versus $1.25. So the midpoint's $1.20. So if I can fill somewhere towards the midpoint, we're paying a net debit of $2.25. We're 4 points wide. We're paying $2.25. That would be our max risk. Our max upside would be $1.75. $4 minus that $2.25. But one of the nice things here, we're not as worried about time decay in the instance like we would be if we bought a long call outright. By selling this other call, we are capping our upside on this. And it is an ETF. It's made a wild swing recently, but we'd be happy. We're basically looking at approximately a 50-50 bet. You know, our max risk is $1.25. Our max upside is $1.75. And so to show you something similar to the options playbook, this is the real-time profit and loss graph inside the Ally Invest option chains. And we see this is where the current stock is at, right there. We want it to go up to the 124 level. And it's always better in long call spreads that it happens closer to the expiration date. So we have an 18-day option contract that we're dealing with here. And if I'm buying long spreads, I'm going to look more to do a shorter time frame as opposed to just buying an option outright. If I were to look at buying a long call as an alternative trade, I would have probably went out a month in time as opposed to 18 days, okay? So here's the benefit here, is that if we do this trade and the stock, as you're correct on your forecast and the stock approaches the upside, then we can change the days to expiration. And I'm going to go all the way down to about 3 days. And now you're going to see this line move quite a bit. And now you see that the actual, as of today, colored line inside the profit and loss graph is now starting to move towards the dotted line overall. All right. So let's officially make this our paper trade of the day. And we're going to do that by adding it to our right rail over here. And this is the Ally Invest trade ticket. And then overall, if we want to see the big picture of the trade that we're going to talk about today, then we go to the bigger trade ticket here. And this is the order entry page for long spreads inside Ally Invest. So let's summarize. We're looking at the February 28th expiration. We have 18 days remaining until that expiration date. We're going to be buying a little bit in the money option contract. That's the 120 strike. We're going to be selling a little bit out of the money option contract. That's the 124 strike. The net, the midpoint, which we're going to focus on with our trade, that's where we're going to be trying to get this thing executed at. It's never guaranteed, is $2.25. That's going to be our max risk, but don't forget, we got to add commissions onto that. You always want to think about that. And overall, this is a long call spread on IBB, and that's going to be the trade of the week or the stock of the week. All right, let's get to some of your questions now that we have. Feel free to type them in the question and answer box. We'll address any of them. Do we have any available right now? Okay, so the first question that we have is for Lindsey. And Lindsey, we are talking a little bit about the markets in general. No, well, I'm sorry, the question just changed. All right, so the first question's for me. Let me start that over. You mentioned volatility was high. Would it be feasible to sell a short put spread as opposed to buying a long call spread? Well, yeah, that's actually not a bad trade either if I'm looking at this, but I don't know if I like the risk reward for the short put spread. So the concept would be that if I sell a put spread, I'm only bringing in, or my maximum upside would be the net credit received. And the fact that we have a little bit increased volatility, and we actually saw that more so in the chart than we saw in the implied volatility of the option contracts, makes me a little bit more nervous to do a short put spread. It's all about the risk reward. On a short put spread, you have a little reward with a lot of risk. On a long call spread, you have a little bit more risk, but a lot more reward overall. So I like the long call spread a little bit better than the short put spread, just because of the volatility that we saw in the chart recently with the 100% retracement in IBB after the big down move. All right. So Rena, here's the question that I thought I was going to ask you. Rena says, what do you make of Moderna mRNA with regards to being the only one with a vaccine for the coronavirus that the NIH is backing? I apologize, I can't see it very well. So are you familiar, Lindsey, with mRNA?
I'm actually not familiar with that stock in particular, I have to admit, but I think that the fact that they are the first ones to have what could be a vaccine obviously bodes well for the stock. And I'm sure, I don't know what it's doing right now, but I'm guessing it's popping on the back of that news. But I do think overall it just shows that the innovation lies in the biotech and pharma space in general to help us solve these crises going forward. So, I mean, I just think that when I think about the biotech space, or even biopharma, when you think about it, like I said, Allergan buying AbbVie, this is a very hot space right now. It is the future of medicine in general. We are entering a time period where our population, especially in the U.S., is aging very quickly. So I think having at least some exposure to this space in general is probably a good plan for a longer term investing strategy. But I also think that the options trade that Brian laid out could be a good way for you to play the strategy in the short term, where other sectors might be favored more in the later stages of a bull market. But I think there could be opportunity. So. Sorry I couldn't answer your question directly, but I hope that what we talked about today was helped inspire new ideas for you.
All right, and overall, you speaking of sectors, we got a great question here. We got TechHead 508. All the FANG stocks are up today. What do you think about the tech sector in general? We did talk about the FANG stocks a little bit on the opening. Lindsey?
Yeah, I mean, I think the tech sector really they had great earnings, actually, the best earnings of all 11 sectors within the S&P 500. If you look at a combined top and bottom line, so sales and EPS results, 80% of the companies that have reported beats on both sales and earnings. There's no other sector that comes close to that for the quarter. So I think the outlook for the sector is very solid, and I think that you just see investors really gravitating to those names with organic growth. So I think that's going to be a trend that will continue throughout the year.
All right, and we have one more question. We can just expand that a little bit. I have one more question. This one's for me, it looks like. Gadget Pip. Did that adjustment on the graph change the expiration on the forecast, or did it change the overall option expiration? All right, so the graph that we're talking about there was a P&L graph. It's a profit and loss graph, and it's inside the Ally Invest platform. And one of the nice things that you can do is you can say, okay, as of today, what's the profit and loss of our long call spread? As of today, if the stock goes up to the strike price, would I be profitable, and how much would I be profitable by? If the stock goes down to the lower strike price that we're buying in our long spread, would I have a loss on my hands, and how much of a loss would I have? And the one biggest thing about option trading is it's all about time premium. So the nice thing about the profit and loss graph is that as you change the days to expiration, that expiration doesn't change, but the graph will move relative. And it will take the time premium out of the option contracts and say, well, if I'm correct on my forecast and we're approaching the expiration date, what does that do to the overall profit and loss on my position that I have on? So it's always done in theory. It's not meant to be an exact science, because you never know how all the conditions in the marketplace might fall. But if everything stays the same as of today, it gives you kind of an outlook as to what I could make on day 10 of my 18-day expiration option contract on my long call spread if my forecast is correct. So that's a great question there. And with that, I think that's going to sum up the questions. All right, Lindsey, let's get back into the summary. Let's start by market indexes overall.
Yeah, we'll go quick since we're kind of at the 30-minute mark. But the indices, there's some indecisiveness. Prepare for a little more volatility in the near term. Would like to really see some stabilization within the markets here.
All right. And then stock of the day, IBB.
IBB, I think there's a great short-term play to be had here in this period of market volatility as investors seek some defensive exposure in their portfolios.
Right. So by looking at IBB and just in general, we got some great questions. One of the short put spread was a viable trade overall. We got a little bit of a higher price stock with a little bit of volatility in it. But overall, I want to manage my risk of this trade because we are doing it in the short term. We're only going out 8 days. We're going to bank on the fact that maybe the markets will continue because the markets were a little sketchy last week on concerns of the coronavirus. But now we've seen a retracement back to the point where we made the big down move. We saw that both in the SPX and in the IBB. And overall, let's see if that trend can continue. And this is a trade that would take advantage of that. All right, now that's it for the stock play of the day. Now I have to let you know that next week, the markets will be closed on Monday for a holiday. So we will not be around next week. It'll be 2 weeks' time. So you want to make sure that you click subscribe. And you also want to ring the bell so you make sure that you get the alerts for all of the stock plays of the day going forward. Thanks for coming, and we'll talk to you soon.
See you in a couple weeks.